Lesson 6, Portfolio Performance. By the end of this lesson, students should be able to 1. Explain portfolio returns on a time-weighted and dollar-weighted basis, and 2. Compare the relative risk-adjusted returns for different portfolios by using the Sharpe ratio, Treynor ratio, and Jensen index. In this lesson, you will examine the topic of investment returns. Measuring portfolio return is not always a straightforward process. Active portfolios present measurement complications, including cash inflows and outflows, and holdings with different risk-return profiles, etc. Because of these issues, different performance measures are appropriate for different portfolios. In Lesson 1 of this investments course, you learned that the holding period return, or total return, consists not only of all distributions during the period, but also the realized or unrealized capital gains. The formula for HPR, or holding period return, is income plus capital gains divided by the beginning of the period investment. What is the 5-year holding period return, the average annualized return, and the geometric annualized return for an investment of $10,000 that is now worth $17,500? Solving for the problem of a $17,500 ending value, a $10,000 cost, and a 5-year holding period, the 5-year holding period return is calculated as the gain of $7,500 divided by the investment of $10,000, or 75%. The average annualized return is calculated as the 75% total return divided by the number of periods, or 5, resulting in a return of 15%. The geometric or compounded annual return is calculated as 1.75 raised to the 1/5 power minus 1, or 11.8%. The holding period return, HPR, is useful for 1-year periods, but it has shortcomings when used to describe multiple periods. Certainly, there is a difference between doubling your investment in 1 year versus taking 5 years. There is also the problem of cash flows into and out of the investment that can confuse the usefulness of multi-period holding period returns. 2 useful performance measures are the dollar-weighted or internal rate of return and time-weighted return. The dollar-weighted return, DWR, is also referred to as the internal rate of return. It is the return an investor earns on their investment. As you learned in Business 591, the internal rate of return equals the present value of cash inflows to cash outflows, i.e. the net present value of all cash flows equals 0. Because it takes into account the timing of cash flows into and out of an account, dollar-weighted return can be a very useful measure of a portfolio manager's performance. Dollar-weighted return is not appropriate for comparison to market indices and may not be appropriate for comparison to other portfolios. The time-weighted TWR return is not affected by portfolio cash flows. It is simply a measure of the portfolio's return during a time period. TWR can be used to measure return between cash flow contributions or withdrawals. Those stub period returns can then be used to calculate a compound rate of return for the entire period. TWR is appropriate for comparison to market indexes, but may or may not be appropriate for comparison to other portfolios. Let's apply these measures of return by working through the following question. A client invests $10,000 at the beginning of year one, $20,000 at the beginning of year two, and withdraws all proceeds at the end of year five. The end of year value in years 1 through 5 were $12,500, $36,000, $42,200, $48,400, and $56,000 respectively. Calculate the following. A, the dollar weighted or internal rate of return. B, the time weighted return using geometric averaging. And C, the time weighted return using arithmetic averaging. The spreadsheet on this chart shows the timing of the cash flows. Dollar weighted return or internal rate of return is the rate that equates the present value of all cash inflows to cash outflows. As you see, a rate of 15.43% makes the net present value equal to 0. That is the dollar weighted return. You could also work this with a financial calculator. The proper inputs using the HP 12C are minus 10,000 cash flow in period sub-0, minus 20,000 cash flow in the next period, 3 periods of 0 cash flow, a final cash flow of 56,000, and then hitting IRR percent. The answer, again, 15.43%. You should check the handbook that came with your financial calculator to figure out how to solve for the internal rate of return if you have a question. The first step for calculating time-weighted returns is to calculate the individual returns for each period. The dollar return in the first period is $2,500. That's $12,500 end of period value minus $10,000 beginning of period value. The $2,500 return, when divided by the beginning of the period value, yields a percentage return of 25%. Following that procedure, you could calculate the other percentage returns as well: 10.8%, 17.2%, 14.7%, and 15.7%. Note that the beginning value in year 2 is the $12,500 end of year portfolio value plus the $20,000 beginning of year 2 contribution. The second step is to calculate the geometric average return. The time-weighted geometric average return for this example is calculated as 1.25 times 1.108 times 1.172 times 1.147 times 1.157. The product of multiplying those numbers is then taken to the 1/5 power, and 1 is subtracted from that, yielding 16.59%. Calculating the time-weighted arithmetic average return involves the same identical first step that you learned in the last slide. You first have to calculate the period returns. The second step is simply adding up each of the period returns and then dividing that by the number of periods. The time-weighted arithmetic average return for this example is calculated as 25% plus 10.8% plus 17.2% plus 14.7% plus 15.7 divided by 5, equaling 16.68%. Consider the two portfolios, A and B, that appear on these two graphs. Question: both Portfolio A and Portfolio B finished the year with identical 14% returns. Which portfolio would you rather hold? While both portfolios offer the same return, Portfolio A has less volatility than Portfolio B. The risk-averse investor would select portfolio A because it offers a higher risk-adjusted return. Three standard measures of risk-adjusted portfolio performance are the Sharpe Index, the Trainer Index, and the Jensen Index. The formula for the Sharpe Index is the return of the portfolio minus the risk-free rate divided by the standard deviation of the portfolio. Notice that the index is a risk-adjusted measure of excess return. The portfolio's excess return minus the risk-free rate, is adjusted for risk by dividing by the portfolio's standard deviation. Because excess return is in the numerator, a higher Sharpe index is preferable. Do you see how comparisons can then be made to the Sharpe index of other portfolios? While two portfolios may offer identical excess returns, they may have very different risk-adjusted returns. What is the Sharpe index of a portfolio giving the following portfolio return of 15.5%, a risk-free rate of 5.3%, and a standard deviation for the portfolio of 20.3%? The Sharpe index is calculated as 15.5% minus 5.3%, and that difference is divided by 20.3%. The resulting calculation is 0.50. Is 0.50 a good Sharpe index? Remember, the index is a measure of relative performance, and the higher the number, the better. So, if another portfolio manager has a Sharpe index of 0.40, the 0.50 is a good number. If another portfolio manager has a Sharpe index of 0.80, then the 0.50 isn't such a good number. The formula for the Trainer Index is the return of the portfolio minus the risk-free rate divided by the beta of the portfolio. With the Trainer Index, the portfolio's excess return of the portfolio minus the risk-free rate is adjusted for risk by dividing by the portfolio's measure of systematic risk, i.e. beta. This index measures the volatility of the diversified portfolio relative to an index or the market. Comparisons can then be made to the market or Trainer Index of other portfolios. Because excess return is in the numerator, a higher Trainer Index number is preferable. What is the Trainer Index of a portfolio given a portfolio return of 15.5%, a risk-free rate of 5.3%, and a portfolio beta of 1.2? The Trainer Index is calculated as 15.5% minus 5.3%. That difference is then divided by 1.2. The resulting calculation equals 0.085. Similar to the Sharpe Index, the Trainer Index is a comparative measure of performance, and the higher the number, the better. The Jensen Index, or the alpha of a portfolio, is equal to the return of the portfolio minus the sum of the risk-free rate plus the market's premium adjusted for the portfolio's beta. This formula appears on the slide. Let's look at this formula. Notice that the required return based on the capital asset pricing model, risk-free rate, plus the market premium adjusted for the portfolio's beta, is subtracted from the actual return of the portfolio. The excess return, actual return minus required return, is referred to as alpha. Alpha quantifies the performance of a portfolio as compared to the market or benchmark index. A positive alpha indicates good performance. A negative alpha indicates sub-performance. The Jensen Index effectively measures the volatility of the diversified portfolio relative to an index or market. In this lesson, you learned about time-weighted and dollar-weighted portfolio returns and risk-adjusted returns for different portfolios by using the Sharpe ratio, Trainer ratio, and Jensen index.